Welcome back to Alpha Recap, your end-of-day, end-of-week briefing from StockAlpha.ai. We're looking back at a volatile session that left markets closed at 6-month lows, with oil pushing close to $100 per barrel and geopolitical tension around Iran in the background. As always, if you have questions, you can reach us at StockAlpha.ai.
Good to be here. Big week, big finish. The backdrop was classic risk-off. Energy spike plus geopolitics, and that set the tone across a wide slice of names.
So, what really stands out here is the combination of macro and micro fireworks, giant one-day moves in tiny names, meaningful flows in leveraged ETFs, and a couple of structural headlines that could matter for months. We'll unpack each piece.
Let's start with the top line. Markets closed at 6-month lows, and oil was flirting with that psychologically important $100 level. That pushed investors into defense and made earnings sensitivity look a lot more dangerous.
Right. And the other thing is, we saw extreme single-session moves. One small company surged roughly 230% in a day. That was dramatic.
Yeah, that tracks. At the same time, the triple-leveraged long Nasdaq product finished down just under 6% on very heavy volume, and the inverse small cap short was up about 5% on even more volume. Those prints tell you de-risking and tactical hedging were active. And then there were the low-price names. One collapsed almost 20% to pennies on huge volume. Another was down double digits. Those liquidity storms wipe out positions fast.
Not a great day for retail traders in those spots.
Honestly, I was a bit surprised by this one. The volume was telling, think tens or hundreds of millions of shares, and that kind of participation can create violent intraday moves regardless of fundamentals.
Let's unpack the mechanics for a second, because that helps listeners understand why a leveraged ETF moved so sharply. Leveraged ETFs aim to deliver a multiple of daily index returns. So a triple leveraged long will go up or down about 3 times the daily move. They rebalance every day, which means in choppy markets, they can exaggerate losses and gains.
Exactly. And because of daily rebalancing, if the market zigzags, those products can underperform what people expect over longer periods. But in a single session of de-risking, they amplify pressure on the underlying large-cap tech complex.
Right. So when that triple-leveraged Nasdaq product fell just under 6% on roughly 120 million shares, it wasn't just the headline. It suggested momentum players were exiting.
And the inverse small-cap short, going up about 5% on roughly 150 million shares, implied small-cap hedges were busy as well. So both ends of the leverage spectrum lit up.
Quick reactions. Big move.
Right.
Now shifting to policy, the U.S. Treasury issued new general licenses tied to Venezuela and explicitly referenced critical minerals. That's a structural story that could loosen supply chains for batteries and electric vehicles over time.
But it's important to temper expectations. Operational realities, transport, processing, contract negotiation, mean any material change in supply would be gradual. The license opens doors, but politics and logistics will determine how fast companies can pivot.
So, what really stands out here is the timing. With oil higher and energy driving cost pressures, any potential easing in critical mineral supply is welcome, but it won't offset near-term margin squeeze if energy costs keep rising.
Exactly. Higher oil, near $100 per barrel, raises the risk of stagflation, and that tends to favor defensive sectors while compressing multiples for growth names. Analysts broadly agreed that the oil move and Iran headlines drove the risk-off tone this session.
And another structural note from tech. A startup called Lightfield launched an AI-native customer relationship tool that promises 1-hour automated migrations. That, on paper, cuts switching friction dramatically.
But switching is more than just moving data. Even if the technical migration takes an hour, customers still have to worry about integrations, workflows, training, contract timing, and data governance. HubSpot's recent index inclusion and enterprise visibility mean incumbency still matters.
Right, and that's the classic moat erosion debate. If a new player removes the technical barrier, Does the rest of the switching cost fall away? Some analysts say yes, others say no, because enterprise contracts and process changes are heavy.
So the market has to weigh execution risk versus the theoretical reduction in switching costs. If Lightfield can genuinely deliver low-friction migrations and show customer win rates, that's a story. But until we see churn metrics and contract rollouts, it's speculative.
Quick aside, that's one of those items where headline noise can move small incumbents more than giants. Strange days.
Yeah. Moving on. Goldman Sachs framed the coming quarter around a single question it thinks will drive the S&P 500 outlook. That's a strategic way to force scenario thinking rather than making a trade call.
And what that question boils down to is really about leadership. Do we get growth-led outperformance, or do cyclical and defensive sectors take over because inflation stays sticky and growth slows? It's basically a choice between inflation persistence and growth resilience.
Market participants disagreed on which side of that question they favored. Some saw the oil and geopolitical headlines pointing to cyclicals and defensives. Others thought the dramatic small cap flows were transitory and that growth could reassert itself if macro headlines cooled.
I mean, when you step back and look at this, that framing is useful. It forces investors to decide what would change their allocations: a persistent oil shock, a clear Fed pivot, or earnings that surprise on the upside.
Right, and in practice that means watching three things closely: oil direction and any geopolitical developments, Fed rhetoric or data that changes rate expectations, and actual earnings beats or misses that alter sentiment.
Short reactions. Watch oil, watch the Fed, watch earnings. Let's make this practical for different investor types. Short-term traders should have expected continued high intraday volatility. The volume prints in leveraged products and speculative small caps made that a fertile yet risky environment.
Swing and tactical allocators needed scenario plans. If oil stays elevated, sector leadership shifts toward defensives. If oil eases and risk appetite returns, growth could bounce back. Defined time horizons help manage those bets.
And for long-term investors, the Treasury license and the CRM debate are medium to long horizon themes. Those are not reasons to react to one day's price moves, but they are worth monitoring for real structural change over quarters and years.
Sector specialists should keep a close eye on margins in consumer and industrials if oil pressure persists, and on churn and contract timing in enterprise software if new migration tools start to prove themselves.
So what really stands out here is risk management, position sizing, stop losses, and liquidity planning, especially around those hyper-volatile small cap names and leveraged products.
Agreed. And parse headlines carefully. The Treasury license is a policy change, yes, but execution determines market impact. The same goes for the CRM migration claims. The technical promise is one thing, commercial adoption is another.
Let's close with three clear takeaways. 1. Headline risk, oil and geopolitics pushed markets into a risk-off posture, and that dynamic will be the primary cross-market driver in the near term.
2. Extreme volume and price moves in leveraged ETFs and low-priced names reflected tactical flows and momentum participation rather than immediate fundamental revaluations. So expect episodes of violent short-term volatility.
3. Structural developments. The Venezuela licensing for critical minerals and the light field migration narrative are worth watching, but their real impact depends on execution timelines and customer adoption.
Quick reactions, that sums it up nicely.
Before we sign off, a quick reminder on the investment disclaimer. Our discussion was informational only. This is not personalized investment advice, and we're not recommending buying, selling, or holding any specific security. Analysts note the environment was tilted to caution, with episodic speculative activity.
If you want to dig deeper into any of the items we covered, oil, the Treasury licenses, the leveraged ETF prints, or the CRM competition, head to stockalpha.ai, where you can ask us directly and we'll answer live through the Q&A feature.
For more market analysis and show notes, visit stockalpha.ai. And if you have questions about anything we covered today, head to stockalpha.ai, where you can ask us directly and we'll answer live. For more market analysis and insights, visit stockalpha.ai.
Thanks for listening. We'll be back after the next session to recap what changed and what that means for portfolios.
See you next time on Alpha Recap. Take care.